This week, I started by writing about US oilfield service returns. I studied the financial results for 19 publicly traded US oilfield service companies. And what we saw was that return on capital employed has actually gone up over the past year from about 14% this time last year to 15% this year. That's surprising to see increased returns on capital when we've had so many headwinds around US activity levels. In the post, I look at specific results for different oilfield services companies. We see that Weatherford now leads the pack on this metric, and that was not the case at this time last year. We saw that Liberty and RPC, their returns levels have come way down, not because they're bad today, but because last year they were anomalously high. So we're seeing some normalization there. We're seeing big upticks, like I already said, from Weatherford, from Cactus, Wellhead, from Champion X. So there's been some really interesting movement within this portfolio of companies. But again, on the whole, returns have actually ticked up slightly over the past year, which is surprising given what we know all these companies are battling against in the U.S. oil field. My next post for this week was about U.S. demand for gasoline, jet fuel, distillate, and how, as a group, that demand is down. And for gasoline, it's down 6% from where it was before the pandemic in 2019. For jet fuel, it's down 7%. For distillate, it's down 8%. And in the comments, I wrote that the U.S. economy, real GDP, has grown 11% over that time frame. Payrolls are up, real earnings are up, industrial production is up. So the economy continues to grow, whereas demand for these fossil-derived hydrocarbon liquid fuels is below where it had been before the pandemic. So we're seeing a real reduction in the intensity of hydrocarbon fuels relative to the U.S. economy. And of course, electrification plays a role, biofuels play a role, increasing fuel efficiency standards play a role. We talked about in the comment section. In fact, there's less commuting today because of trends from the pandemic, and so we're seeing a lot of different dynamics that are resulting in lower demand for these big hydrocarbon fuels here in the U.S. even as the economy grows. That has real implications, of course, for the U.S. market, for global markets, for import-export realities. It's an interesting topic. It's something we'll continue to explore. My third post this week was about my upcoming presentation to an SPE group, where I'll be talking about how E&Ps and oilfield services companies are navigating the challenging North American market. If you're available and are interested in that kind of talk, I definitely encourage you to come. I would love to meet anyone who happens to be there in person. It'd be a great way to hear a bit more about the kinds of research that I share here on LinkedIn, but in a longer format where we can engage in Q&A and have a good discussion around it. My last post this week was about the sales growth for US electric vehicles. And what we're seeing is that sales growth is coming down and has been coming down since the beginning of 2022, frankly. For battery electric vehicles, sales growth has fallen for 13 consecutive months, and it's down for 23 of the past 29 months. For plug-in hybrid electric vehicles, sales growth has declined 3 consecutive months, and it's down well off the highs from the beginning of 2022. These growth levels are still way above the light duty fleet as a whole. So the light duty fleet is absolutely being remade in the electric direction. It's just the growth of these vehicles has come down considerably from where it had been just a year or two ago. And that helps explain, it's part of the reason why we've seen some pauses, some cancellations in EV programs from major automakers, because as these sales growth levels come down, then these longer term projections of what you'd expect total sales volumes to look like over the next 3 years, 5 years, 7 years, really start to compress. And so it makes it harder to justify investing as much as these automakers would have invested a year or two ago. It's a very fluid situation. And so expectations are evolving rapidly as we get new sales numbers in. My Foundations of Energy post this week will be all about U.S. upstream E&Ps, oilfield services companies, what we're seeing in terms of the consolidation in that market, what we're seeing in the evolving financial performance trends, the evolving operational realities. I'm going to package a lot of that up and put it together on Foundations of Energy, which is the learning and development program that I've built and host there at Substack. Each weekend, I send out a free weekly newsletter that includes links to and summaries of all the research that I publish online during the week. That way, you don't have to rely on social media algorithms to find all the stuff that I shared. I also include an energy-related anecdote, insight, or observation that I don't share anywhere else. So if you've seen all the stuff that I've published online, you'll still have something new to read in the newsletter. If you haven't signed up to receive that, you can find a link in my profile. I'll also put one down below. As always, thanks so much for reading, watching, liking, commenting, participating in general. I really appreciate it. I hope you had a fantastic week, and we will talk soon.